Canadian IPOs are shrinking, and more companies are choosing to leave Canada's primary stock exchanges, including the Toronto Stock Exchange and the junior TSX Venture Exchange. My next guest believes that the market has hollowed out a little bit, and it's a concern. Let's bring in Dan Nowlan, Vice Chair at National Bank Capital Markets. Dan, thanks very much for joining us.
Morning, Roger.
This is a trend. It's been going on for a while. Just how bad is it to you?
Well, I think, first of all, I think there's good news and bad news. First of all, you're right. Over the last, since 2023, there have been about $125 billion of companies, of value of companies that have left the Toronto Stock Exchange that have been taken private. Some have merged with other companies. Some have been bought by private equity. Some have been bought by strategics. And there hasn't been the IPO pipeline to replace those. Now, I would say over the last year, and going into 2026, we're seeing a lot more companies considering going public again, but they do tend to be larger companies than we had seen, say, in 2021.
Which I guess that's a good part, that you're seeing some coming back on as IPOs. But what's your worry about not seeing small caps?
Yeah, well, I think the issue is if Canadian small cap companies can't use the public markets to get capital at the right valuations, then they will start to look elsewhere. And if they get bought by, say, a U.S. strategic, then there's a risk that those jobs might not stay in Canada. Those head offices might not stay in Canada, and Canada might become a bit of a secondary consideration for those small cap companies. So I think it's important for the country to be able to maintain high quality, good paying, long-term sustainable jobs, to be able to keep those companies as active participants in the market and have them be able to access capital efficiently.
And now we love to talk about the big ones, Mag 7, things like that. Just how important are the small caps?
Well, I think they're important economically, certainly. And we do hear from institutional investors that they just feel that there aren't enough good quality small cap names in Canada to look at. And largely we had, as I mentioned, $125 billion of value taken private over the last 2.5 years. 54 companies were taken private in 2025 alone. And there was another 40-something companies taken private in 2024. So it's a lot of companies that have left the market. How
do we change that? How do you think you can change that?
Well, I think there's some things the government could do. For example, make it more attractive for investors to take risks. We've punished risk taking in this country with a debilitating tax system. So there's things that the government could do, I think. And one of the things is the institutions that have stopped looking at smaller cap companies, they're behaving completely rationally because they become larger and larger, and it's tough for them for it to make sense for them to look at smaller cap companies. So one of the ways, I think, is to encourage retail investors to maybe take a closer look at some of the smaller cap companies.
And just going back to the government, I mean, that's always been a concern, really, that we're too taxed. Has it gotten worse, though, for those companies?
Yeah, I mean, I think if you look back since the financial crisis, and especially since the last 10 years when taxes have gone up, they've gone up incrementally. Last year, the federal government tried to bring in even more taxes on capital gains, which led to some people to take action. Ultimately, that measure was repealed, but not before a lot of people, reacted to that. So there's been a continued, I think, lack of encouragement for people to take risks and invest in growth companies.
And what's the allure for the going private? It's just the sale? Is that when it's hard to resist, or what? Why are we seeing more companies doing that?
It's just if you're a smaller cap company and you don't have access to a proper valuation, there's a lot of reasons you might go private, but one of them might be that it's tough for you to make acquisitions because your currency just isn't appropriate to be able to make acquisitions and become bigger. So that's one of the drivers. Each one of the M&A stories has their own story attached to it. Mm-hmm. So there's a lot of different reasons, but it's easy for a successful, perhaps small Canadian company who doesn't have the proper valuation, if they're approached by a larger American strategic, to say, something that's a pretty good opportunity, and that's my one way that I can continue to grow with a partner.
And is there a danger that we could end up with a hollowed out TSX or a hollowed out Canadian markets?
Yeah, I mean, what you're seeing right now is you're seeing the larger cap companies have performed quite well. The TSX is up 25% this year. So those companies have done quite well. They continue to grow. The companies have gotten bigger and bigger. Where the area of weaknesses that I see is, again, that smaller cap part of the market.
And is this a cyclical thing, or has this been something that's been going on for a while?
The trend feels like it's been going on for a while. But I would say it's gotten more acute since the second half of 2021. So in the first half of 2021, small cap companies were successfully accessing the market, many of them technology companies. But since then, it's been very difficult. And if you look at the shareholder base of small cap companies with, say, less than $1.5 billion market caps, you'd see that the institutional shareholder base is significantly smaller now today in 2025 than it would have been in, say, 2020.
Okay. Dan, thank you very much for joining us today.
Thank you very much.
Dan Nowlan is Vice Chair at National Bank Capital Markets.